So, the fun begins now. That's the first lesson. This is the first lesson, the first actual lesson, because the first video was an introduction, also a way to know each other, and from now on the lesson will be like this. So I prefer presentation approach. So you have a more I present the content in a more schematic way, and you have a more precise way to learn them. So, first lesson, as anticipated, will be on network of price, market profiles, and SMT. And I will remind you, or I will go over some topics that I mentioned on the introduction, because I want you to start with the right perspective in mind. So put your mind in the right perspective before starting. And that's actually a thing I struggled with for a long time, and but I was able to find a light at the end of the tunnel. Many people die in the process. It's if you start with the right mindset from the beginning, it's way, way, way simpler to overcome every obstacles that is between you and your goals. So every journey should be engaged with the right mindset. So the first question you should ask yourself is, what are the markets? And more importantly, why were they created in the first place? The key here is why. We always the greatest trader I know, and I know some are in the Jeffs group also, but everyone always ask himself why. Why this? Why that? Why that happens? Why was my stop loss hit? Why did I miss this? Why is important? And this is the greatest why of all. Why were the markets created in the first place? The short answer is to take all of your money. And that's the reality, because the markets, and I know that can seem like a rant, but I will go over the important stuff later. But this is essential, because you will trade with the right perspective in mind. So the markets is a powerful machine, a powerful way, and not so obvious to most people, to move money in the global economy. And since the 1700, where the first stocks exchange, and go over these topics, it's not useful, obviously, but really fascinating for me. The first company to be listed publicly, the first contracts, futures, to speculate on agricultural products, were always created to make money circulate. Because it's another way. When the economy and the finance world begin to begin to become too complicated, the people that rule this thing needed to figure that out, a way to move money more efficiently in the global economy. And that's a way. So over time, obviously, more types of financial instruments will be created, and that's why. But the market is a perfect place to lose all of your money. Simple. And it's really, really well designed to do so, because every single price fluctuation is designed to fuck you. And I recently tweeted about this, but if you are trading for at least 2 months, I say, there was at least one time probably that you were very, very, very frustrated because price seems to always run against you, to always try to trap you in some sort of pattern, you see, or that's because price fluctuations, not movements or direction, fluctuations are the biggest thing that fucks many traders, because it's amazing how you see in price action things that are not there, and that's a human psychology. Another fascinating thing, but I will go over this. So the markets are controlled. That's an important thing to keep in mind, but not how the general public think. ICT, Michael talks about the IPTA, so the Interbank Price Delivery Algorithm, and many people think that every single price movement is controlled. Actually, if it was like this, it would be like discovered many years ago, and the way it is controlled must not be so obvious to remain legal, to remain doable, let's say like this. So actually, in which way the market is controlled, and some market in a different way than the other, because for example a stock, Apple stock or the Nasdaq, if you notice, moves different than gold or soybeans or than a forex pair, because the true supply and demand of that product is more or less relevant. For example, the supply of gold is real. People, states, businesses needs gold, for example gold, but they don't need euro versus yen. So the forex market is one of the most controlled one, and it for this reason is the one of my favorite and one of Romeo's favorite, because if you understand how it is controlled, then it's pretty easy to anticipate it. But it is controlled in a constructive way, so the movements of price are timed, and the price is moved by buyers and sellers, so institutional buyers and sellers, and retail in the smallest part, because we make up only 6% of the total market participants. So, but it is moved by buyers and sellers, but they can't actually go beyond the anticipated and chosen level by smart money. So they keep price in range in a specific time, price range for a specific time period. At a specific time they release and they sponsor, and in the market profile section I will go over this. They sponsor the price movements, and if you go into your chart, you will see that at a specific time almost every day price start to rally for no reason. That's why they sponsor to bring price to a certain level of interest for their business. In the long run, so on the higher time frames, like on the monthly, obviously price is moved by fundamental reasons and global interest, and it is all engineered. Intraday and intra-week, it is 100% more controlled, because it's important how price closes at the end of the week or at the end of the day. It is a big range day. Nobody cares if price in a week go up, down, up, down, up, down, down, and then close it at the same price level. That's why they can play inside the interweek time frames to speculate on that market. Also, you know that, and I will elaborate over this, but economic news events are used to accelerate the delivery of price to certain levels. So, smart money don't care about us as liquidity, don't care about our stop loss. They did what they did. They provide the liquidity to the marketplace. They are liquidity providers. If you search on internet, they exist, and it's a job. So there are big center that provides liquidity to the more illiquid market, and this is a role of smart money. And the market makers, they also manipulate price to make money, to speculate like us in a different way, but that's their objective. If we are on the wrong side of the market, we are simply standing in the way. They are not coming after us. They are on their own path. So let's coming to the end of this rant to prepare you, to put you in the right perspective. Why a time-based chart? Well, after all this speech, a time-based chart is obviously the only way to see the market's behavior by the price scale, the price perspective, and the time perspective, because pattern happens on the price scale and on the time scale. When you blend the two, you get a pretty good result. And this will be what I will teach you, and what Romeo and ICT talking about. So everything else added to a time-based chart is extra. I'm not saying it is useless, but is extra. So unlike ICT, I don't shit on volume profile. I don't use it, but I don't shit on footprint charts. I don't shit on DOM, depth of market. I simply think they are more a tool to see inside the candle after they happens. So if there is a big movement in price, you can see that, for example, 500,000 lots were executed below this low. So you can see, you can say, smart money entered here, a big player entered. That's where the liquidity pool was. Fantastic. But you can see this after it happens. So you can, how people use it, how people use the footprint chart, for example. They saw a big player that entered. They see the market that moves in that direction, and they simply jump on the wave. So it is a way to look at a chart, but always in a time-based manner. Now, With this logic, you can anticipate levels of interest where that 500,000 lots are likely to be executed. So it is an anticipation and not a reaction. It's more difficult, yeah, but it is also more rewarding. And you saw that. So let's go into market profiles. As promised, there are two, and I talked about this, there are two types of markets. Trending and mean reverting, also called consolidating markets. Generally, and I hinted about this, some markets are more historically speaking trend continuation markets, and some markets are more mean reverting. So the forex pairs are mean reverting markets generally. Then on some period of the years, big trends start. Markets like commodities, indices, stocks are more trend following, but that's on a general scale. Said that, only two types of market profile exist, trending and consolidating, and we understand, we frame what type of market profile is the current one by using four actually. Highs and lows, my favorite. Gaps and order blocks as another layer of confirmation, and candle closure as an indication, not always mandatory, but another confirmation. So highs and lows are the most important thing, because as you can see, price is price and time is time, and price action can be seen through different time frames. So if you use the 69 minutes time frame, as me or Romeo, I did it sometimes for fun, or you use the 14 minutes time frame, the 3 hours time frame, those ones, not the usuals. Gaps and PDRAs and etc. disappear or appear, and so they are not 100% consistent. PDRAs are a way to internalize price action. PDRAs are important on the higher time frames because those are levels of interest that everybody can see. So gaps and etc. Also the banks see them, also the institutional players, and all the retail investors. So those are important levels, and I focus on them to my trading, not on a 3-minute gap. But markets price action can be seen to different time frames. So the only things that remain the same are highs and lows. If you try to change the time frame, highs and lows remain the same. So no, the maximum, the highest point in a range and the lowest point in a range, no matter the time frame, remains the same. So highs and lows is the most objective way to look at price and to frame market profile. So if we are breaking, displacing true lows with multiple candle closures, like in the picture on the right, we are displacing through that high. And if you look at the lows on the bottom left, we are rejecting it. So we are only wicking through it, and price is quickly moving away. That's the type of signature that we want to see. So if you anticipate it, it's better. If you see that, you can jump on the wave, because that law is sponsored by smart money. Is sponsored by them. They are using it for order pairing purposes. So they don't want to sunk price below it. They are using it to accumulate long positions, while they want to distribute them higher, where not below that high, because they are quickly running through that. In this case, they want to distribute their position at a higher level of price. So when in an uptrend you see a highs being rejected, that means that a reversal or a retracement is coming. So you can frame price action in this manner, and gaps and underblocks, as I said, are another layer of confirmation. So in an uptrend you will see gaps supporting price and down close candles supporting price. In a downtrend you will see bearish gap resisting price, and bearish order block, so up close candle resisting price. So that's another thing you want to check. And finally, candle closures. So as I saw, we wick below this low and we break with multiple candle closures above the high. As I said, this is not a give or take thing, 100% holy grail, because some soups are deeper than others, and so it's an indication. Let's say like this. Now, where and why do we use market profiles? We use it on the higher time frames. Now, higher time frame depending on which candle we want to trade, and I will expand on this topic later. But we frame the market profile on the higher time frame to develop a directional bias, a general directional bias that will be confirmed and refined through other systems. In the next lesson I will go over this, but on the higher time frames to develop a directional bias. Also on the lower time frame to frame a potential, and also on the higher to frame a potential entry or exit point. So if we are on an uptrend, we want to buy the dips below the low. So we know that at higher time frame PDRA, if there is a resting liquidity pool, that's a potential level for us to enter, and a potential level for us to, we don't exit at a random level, we exit above high in an uptrend. And there are specific hikes and lows to consider. Also, and that's more advanced, but market profile helps us also to identify the potential stop loss placement. What I'm saying? We know that a high that rebalances the gap, or a low, in this case in an uptrend, a low that rebalances a bullish FG, or a low that took liquidity while price was moving away fast. Those two types of lows are protected lows, also called intermediate term lows. So when there is a consolidation, if we expect a bullish start of soup to happen, we look to the left. If there is a trusted low, to put our stop loss on. So a level in price, a low, that is not likely to be reached before our drawn liquidity is met, and pounder of this. It is one of the way Romeo taught me to put the stop loss. In level 1, he hinted at this, and he expanded on it later. Finally, and I wanted to incorporate SMT in this lesson because it is highly connected to market profile. What is SMT and how to use it? SMT, and I will dive again into history lesson, but SMT, or Smart Money Tool technique, is a way of determining accumulation and distribution in one asset rather than the other. It is not an ICT concept. It was first discovered by the journalist and trader and father of technical analysis, classic technical analysis, Charles Dow, in the 19th century. So it is a 250 years old concept. Charles Dow was the one that the Dow Jones index took the name from, so not the first guy on the street, and he watched correlated asset and noticed that sometimes, in general at the reversal points, while one asset put in a lower low, the other failed to do so, and that sometimes caused a reversal or a retracement, a change in the direction. Now, used by itself is a waste of time, but used in the right context and at key levels at the right time, it's a powerful tool. It's a powerful confirmation tool. It is not always needed, and you will understand why when you truly digest what an SMT is. An SMT is simply an indication to us of where, not if, where smart money, because smart money are always involved, but where are they more exposed to long position rather than shorts. So the stronger asset, and this is a photo of a recent price action on euro and pound. So the above chart is pound dollar and the below one is euro dollar. In this case, pound created a lower low, while euro failed to do so. In this case, we prefer to long euro because it is the stronger asset. But why it's the stronger asset? Always ask why. It is the strongest because smart money is accumulating long position in both, but more in euro. In the leg down in both assets, they are selling short and going into drawdown to bring price at a certain level, and that's new. But while the level of interest for pound, smart money liked this level, so they want to bring pound down to this level before doing business on pound. Euro, for them, it was more than enough, more than enough discount at this level. They don't need to bring euro down here. What this indicate to us? That euro is in a favorable position to long because it's at a discounted price rather than pound in this situation. We simply ride what they are doing. So if they are showing this, we are with them. Simple. So it is SMT shows us which asset is stronger than the other, and I forgot to mention this, but SMT, we check for SMT between highly correlated asset. So Nasdaq and gold are like 35% correlated. We don't look for SMT between gold and Nasdaq. We want a 85 or more % correlation, because you can go crazy looking for SMT between interest rate and dollar, for example, or treasury bonds and euro, but you will never enter this loophole. So focus on highly correlated pairs, S&P 500, Nasdaq, with the Nasdaq. Let the Dow away. Euro, pound and dollar. Dollar obviously is inverted correlated to euro and pound. And gold and silver. Focus on this. Bitcoin, Ethereum. Let's stick to the basic one. But the important thing, and this keep notes on this one, SMT allow us to know, once the SMT is confirmed with a close above or a close below, let us know with the highly percent probability that a certain level in price won't be touched. So SMT creates equal lows, and I want only to long with the equal lows present when there is an SMT on. I want only to short with equal highs present when there is an SMT between them. So equal lows are created with the SMT on the other pairs, and when equal lows are created on the pair that create equal lows, a rejection block is tapped while the other pair took the low. So SMT create equal lows and equal highs. Left SMT leave gaps unfilled. SMT is the reason for a true breakout of the range. Let's take, for example, today's price action. Mark Monday's range on euro and pound. Pound took Monday low and then reached Monday high. Euro, simply with an SMT at the lows, is breaking out of Monday range. True breakout happens because of SMT, always, or because the range, and I repeat, or because the range is sitting at an higher time frame key level. These are the only two instances a true breakout happens. SMT, so total soup on the other pair, or the range is sitting at higher time frame key level. So I want to repeat myself. Don't make the dumb mistake of writing SMT as a rule, as a strict rule to your model, because SMT is not needed. Is an indication of which pair we want to long or short. Is an indication of where we don't want to see price arrive. And another thing, SMT and God are the only way that can stop your target from getting filled. So if you have a drawn liquidity in mind, when price is near, check for SMT. Because if the drawn liquidity is an FEG, relative equal highs, a previous candle highs or whatever the fuck it is, the only way it will not be reached is because of SMT. Go over this lesson again and again, and we see each other next week. And obviously, let me know if you have any questions. I'll do my best to respond. Hope a good rest of the day. See ya.